Market volatility very simply refers to how much a market is moving around compared to the average. Volatility is traditionally thought of as a type of risk. The more volatile an investment is, then generally speaking, the more risky it is. Right now, in early 2022, investors are perhaps looking at their pensions and investments and seeing that their values are falling. What makes good investment strategies stand out from the rest is the reaction to market volatility and falling values. Investor psychology is the key to this difference. The two key psychological traits of successful investment strategy are discipline and patience. Panic reactions and tinkering with or selling investments due to a market reaction during volatility and downturns are not behaviours synonymous with good investment practice. Meanwhile, prudent investors are often seen to employ patience and discipline and will understand that volatility and downturns are a normal and expected part of investing over the long term. Using the S&P 500 as a barometer, there's only been 4 occasions in the last 100 years where markets have fallen for 2 or more consecutive years. And while buying low and selling high may sound great, research tells us that trying to time the market can be a costly endeavour. This chart from JP Morgan highlights the impact of missing just the best 10 days of the stock market over a 20-year period resulted in a final portfolio worth over 50% less than someone that remained fully invested throughout. Further research highlights that the best days in markets often come close to the worst days. Incredibly, over a 20-year period, 70% of the best 10 days for markets happened within 2 weeks of the worst 10 days. Data also tells us that the longer someone remains invested, then the lower the risk of that person losing money becomes. Humans are naturally risk averse and volatility can be unsettling to some. However, a good financial advisor is there to help educate that investing is not a straight line journey and there will be years where investments have gone down, but focusing on the long-term trend is key. A good advisor will have you set up according to your attitude to risk and explore diversifying your holdings into a variety of different asset classes, which can help smooth investment returns over time by not having all your eggs in one basket.